Hello and welcome to another KYC Lookup video where we bring you AML related content to help you enhance your knowledge in the fight against money laundering. Today we're going to explain what is customer risk rating and when is it performed. But before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. We also have a special announcement to make, so be sure to watch until the end to find out what it is. So, on to today's video. What is customer risk rating? Customer risk rating refers to the money laundering and financing terrorism risk associated with a particular customer from a company perspective. In order for banks and financial institutions to be able to risk rate their potential customers or existing customers accurately, they are required to first have a policy and procedure that follows the latest guidelines from the Financial Action Task Force, also known as FATF, while at the same time applies the AML rules and regulation from the country or countries they are operating in. What risk factors should be considered to perform the risk rating of a customer? In order to effectively perform the risk rating of a customer, there are a number of factors to be considered. Although all financial institutions should have their own methodology at the time of performing KYC, industry practice will focus on the below elements. Customer profile, for example, source of funds, wealth, type of entity, legal structure, and ownership. Industry or sector where the business operated. Geographies where business is conducted. Product, services provided by the customer. Delivery channel related risk factors. What are the different types of risk rating allocated to a customer? All customers are given a rating according to the overall risk they present. The three levels of risk rating are low risk. This is the default rating for clients where there are no factors which could result in a level of risk above low, due to its information in most cases being publicly available. Medium risk. These factors present an increased level of risk requiring more due diligence, and effective mitigating factors can be taken to confirm the risk of the customer as low risk. High risk. These factors make the customer high risk and enhanced due diligence is required and detailed review of the account are required on an ongoing basis, as these factors present an ongoing level of risk. How often should the risk rating be performed? Customers once onboarded should be monitored on an ongoing basis via a variety of ways. Screening. Ongoing screening such as adverse news, politically exposed person, and sanction screening are features that all customers once established should always be monitored against. Material changes. Relationship managers and client-facing teams should always be updated if there are any changes at the customer level, which may constitute a material change of the profile. These changes can be change of board of directors, change of ownership, name change, or changes to the product and services provided by the customer. As well as an ongoing basis, each customer should go through a periodic review in line with the initial risk rating allocated. The frequency of performing periodic reviews varies from company to company and depending on the region you operate in. With no set guidelines from regulatory bodies, companies have taken a risk-based approach at the time of deciding the right timeframe to perform the periodic review. Based on the consultation with industry peers, the standard in the US is every 1, 2, and 3 years, with high-risk customers requiring a periodic review every 12 months, medium 24 months, and low risk every 36 months. In other regions such as Europe, there are more entities performing periodic reviews at a cycle of 1, 3, and 5 years. Who should perform the risk rating of a customer? The customer risk rating is performed at different stages of the onboarding process, depending on the company who is performing it. However, it is highly recommended the risk rating is performed by the customer due diligence or know your customer team. who assesses the information or facts collected and risk rate the client early in the onboarding phase or during the life cycle of the relationship. It is worth highlighting that the customer risk rating allocated at the time of onboarding doesn't mean the risk rating will remain the same during the lifespan of the relationship, as it can be changed at any time taking into account a number of factors. Well, there you have it, a basic introduction to what is customer risk rating, who performs it, and when to perform it. Please tell us in the comments section what is your interpretation of customer risk rating, and what other factors should be considered. Now for the special announcement mentioned at the start of the video. We are now launching our very own courses for you to take a more in-depth look at a variety of subjects, such as Introduction to AML, Beneficial Ownership, and Customer Risk Rating, for example. So make sure you visit our website for further details, and let us help you connect the dots in KYC. Thank you for watching the video, and if you made it this far, don't forget to like and subscribe to watch more amazing videos.